Welcome. In this video, is there a chance that Zbcn coin will increase by 125%? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. The ascending triangle formation is one of the important patterns in technical analysis that can appear both as a strong continuation pattern and, at times, as a reversal pattern. The most characteristic feature of this formation is the presence of a horizontal resistance line at the top and an upward sloping support line at the bottom. In other words, each time the price pulls back, it forms a higher low than before, but on each rise, it struggles to surpass a certain level. This indicates that buyers are increasingly stepping in more strongly, while sellers are doing their best to defend the resistance level. However, when this balance of power begins to shift in favor of the buyers, the upper line of the ascending triangle is broken, and this breakout is usually the start of a strong upward wave. Understanding the psychology behind the formation is important to grasp why it gives such a strong signal. While the ascending triangle is forming, the price makes higher lows each time. This shows that buyers are entering the market earlier and more aggressively. The reliability of the ascending triangle formation depends on the direction of the breakout. Although classically this formation has a higher probability of breaking upward, in some cases the market may unexpectedly break downward. Therefore, entering a trade without confirmation of the breakout is risky. Confirmation is usually obtained when a candle closes above the resistance level. In addition, an increase in trading volume during the breakout is an important indicator that supports the validity of the formation and the strength of the breakout. Breakouts without volume may lead to false moves. During the formation of this pattern, the psychological state of market participants can also be read clearly. Buyers, encouraged by the higher lows, start opening positions earlier. Sellers, on the other hand, become increasingly uneasy as the resistance level is repeatedly tested. The probability of a breakout increases significantly, especially on the third or fourth test of the resistance, because with each test, sellers weaken further. The time frame of the ascending triangle is also important. Ascending triangles that form on daily and weekly charts tend to be more reliable and lead to larger price movements. Shorter time frames, such as 5-minute or 15-minute charts, can also work, but because volatility is higher, misleading breakouts are more common. For this reason, risk management should be adjusted to the time frame when developing a trading strategy. After the breakout, a movement called a throwback is often seen. This means that after breaking out, the price returns to the broken resistance level, finds support there, and then continues its move toward the target. These pullbacks offer a second entry opportunity for investors who think they missed the formation. However, it is important that the support level holds at this point. If the price falls back below the broken level, the risk of the formation failing increases. Because the ascending triangle is one of the clearest signals of trend continuation, most investors gradually increase their positions during the formation process. Large investors, whales in particular, tend to push the price up to the resistance level, keep it moving sideways there for a while, and then execute the breakout with a strong wave of buying. In the scenario you mentioned, if the price breaks the upper line of the ascending triangle, the likelihood of the uptrend continuing is quite high. This is because the breakout indicates, both technically and psychologically, that buyers have fully taken control. For investors, this is interpreted as the resistance is broken, the path upward is now open. This leads to new buyers entering the market and the price rising faster. In summary, the ascending triangle formation is a very strong pattern both in its chart appearance and in the market psychology behind it. The post-breakout target is usually equal to the base height, but if market conditions are favorable, this target can be exceeded significantly. The most important points for investors are to confirm the breakout, ensure trading volume supports it, and apply proper risk management. This way, the opportunity presented by the formation can be utilized in the most effective way. But we cannot base an analysis on this alone. Let's also take a look at other metrics. Stay tuned.
The RSI, or Relative Strength Index, is a very important momentum indicator used in technical analysis to measure the speed and change of price movements, with values ranging between 0 and 100. This indicator can help identify overbought or oversold zones in the market and provide insight into potential price reversals. However, RSI is not analyzed solely with horizontal levels. Just like in the price chart, trend lines, patterns, and breakouts can also be monitored on the RSI chart. This can offer particularly valuable information for trend-following investors. In the scenario you mentioned, there is a newly formed descending trend line on the RSI. A descending trend indicates that each peak on the RSI is forming lower than the previous one, showing that momentum is weakening. However, while such a trend suggests that the price is under pressure, if it is broken, it can instead signal that momentum may quickly strengthen, triggering an upward move in price. Especially when a newly started descending trend on the RSI is broken early, it can create a strong and sudden shift in price action. This is because the trend is still fresh, and market participants are not yet fully convinced of the direction. The breakout signal can suddenly trigger buyers to step in. We can think of a descending trend on the RSI in the same way as a descending trend in the price chart. If each peak in price forms lower and the same is seen on the RSI, there is a strong momentum barrier preventing upward movement. When this barrier is broken, the path for the price opens. For example, if RSI values make peaks at 60, then 55, then 50, and finally 45, this descending line forms a trend line around 45. If the RSI breaks this line and rises above 50, it signals that momentum is accelerating in a positive direction. In technical analysis, the strongest RSI breakouts occur when they happen before a clear breakout in the same direction on the price chart. This means that a trendline breakout in the RSI can act as a leading signal for price. This gives the investor an opportunity to take an early position. For example, if the price is still consolidating at a resistance area, but the RSI has already broken its descending trend line, it often indicates that the price will break upwards soon after. The fact that the descending trend on the RSI has only just started can make the post-breakout price movement even more interesting. Because the trend is short, momentum change after a breakout can be sharp. This attracts the attention of short-term traders. Breaking a newly started trend can sometimes be seen as a false alarm in the market, but in reality, it can mean that the trend failed to hold and has reversed. This can push the price upward quickly. One of the most important factors to watch during the breakout is the level of the RSI. If the RSI breaks a descending trend line while in the oversold region, 30 or below, it usually signals a strong recovery. At this point, the price often bounces from the bottom and accelerates upward. If the RSI makes this breakout around 50 or slightly above, it indicates that medium-term momentum is strengthening. In a more aggressive scenario, if the RSI is approaching the overbought region, 70 and above, when breaking its descending trend line, the price may already be in a strong uptrend and momentum can accelerate after the breakout. To increase the reliability of such breakouts, volume and price action should also be analyzed. For example, if an RSI breakout occurs while the price is also testing a key resistance level and volume is increasing, the likelihood of a false breakout is very low. In such cases, price usually moves quickly in the direction of the breakout. Another important point is that descending trendline breakouts on the RSI can sometimes create a bullish divergence between price and RSI. This means that while price is making new lows, the RSI is making higher lows. This shows that selling pressure is decreasing and the price is preparing to turn upward. If such a divergence exists in the scenario you mentioned, the price rally after the breakout could be even stronger. It's also important to consider the reflection of RSI breakouts on market psychology. Investors may not always spot clear breakouts on the price chart, but since breakouts on indicators like the RSI often give early warning signals, they are closely monitored by professional traders. For this reason, sudden buying orders may come in at the moment of breakout, and the price can make a sharp jump in a very short time. If this breakout is occurring on a long-term chart, such as daily or weekly time frames, the impact of the price move can be more lasting. On short-term charts, moves after a breakout can be fast, but so can corrections. On long-term charts, however, the price can climb step by step after a breakout, and it is even possible to start a new trend. In conclusion, the breakout of a newly started descending trend on the RSI, especially if the price also makes a supporting move, can create a very strong buying opportunity. This breakout signals that momentum has shifted from negative to positive and sends the message to market participants that the price now wants to go higher. This message can cause a sudden change in investor behavior, and the price moves rapidly in the direction of the breakout. The RSI needs to break this.
The cup formation is a well-known and reliable pattern in technical analysis, generally indicating that the uptrend is likely to continue. It forms when price action recovers over a long period from a certain decline and returns to the level where it originally started. In the scenario you described, this is a small cup formation. Its small size indicates both a shorter formation period and a narrower price range. However, the size of the pattern does not always limit its return potential. Sometimes even small cups can trigger large price moves. A cup formation generally develops as follows. First, the price declines from a certain peak level and gradually moves downward. This drop may happen quickly or develop gradually. Then, the price finds its bottom and starts to recover. During the recovery, the price rises step by step, just like one side of the cup rising upward. Eventually, the price returns to the level where the formation began, its initial peak. This point marks the completion of the cup formation. In your example, the fact that the price is very close to completing the cup actually indicates that the breakout is near and the potential move is almost ready to be triggered. When the cup formation is complete, according to the general measurement method in technical analysis, the target price is found by adding the depth of the cup to the breakout level. In other words, the price difference between the highest and lowest points of the formation is calculated and added to the breakout level. This calculation in your scenario points to approximately a 125% upside potential. A 125% target is a very strong return expectation, especially for a small cup formation. This means the price could rise to 2.25 times its current level. This move attracts significant attention in the market because both short-term traders and medium-term investors want to take advantage of this potential. Small cups are generally completed faster, and the price movement after the breakout can develop quickly. This presents investors with an appealing picture of short waiting time, high return rate. The most critical point for the success of a cup formation is the breakout moment. The price must clearly break the top line of the formation, which is the resistance level, and preferably this breakout should be supported by an increase in volume. Volume is an important factor that shows whether the breakout is happening due to genuine buying interest or just a temporary move. Breakouts without volume often turn into false breakouts, and the price can be pulled back down. However, a breakout with strong volume generally indicates that buyers are strong and the uptrend will continue. In small cup formations, after the breakout, the price can often reach the target very quickly. The reason is that, due to the small size of the formation, there is enough built-up energy in the market. During the recovery from the drop, sellers largely withdraw from the market while buyers wait for the price to move higher. At the breakout moment, these waiting buyers quickly take positions and the price gains momentum in a short time. The cup formation is also meaningful from a market psychology perspective. When prices fall, investors panic and sell. As sellers are exhausted at the bottom, the price starts to recover. During the uptrend, investor confidence is restored, and when the price reaches the top of the formation, the market develops the sentiment that the price is back to its old level, it can go even higher from here. This psychological effect strengthens the post-breakout rally. If the 125% target is achieved, it can also trigger a new wave of buying among investors. This is because a price that rises sharply can lead to the triggering of other patterns in technical analysis. For example, reaching the target of the cup formation could bring the price close to the upper band of a larger rising channel or to a major previous resistance level. The reliability of this formation increases even more if the volume profile during its development follows classic rules. Ideally, volume decreases as the price falls, shows low levels at the bottom, and gradually increases during the recovery. At the breakout moment, a sudden and clear volume surge strengthens the probability of the price moving toward the target.
Cup formations can also turn into cup and handle patterns. In this case, after completing the cup, the price does not immediately break upward, but instead makes a slight pullback and forms a small consolidation area. This further increases the reliability of the pattern because during the handle stage, weak hands exit the market while strong investors hold or increase their positions. If such a small handle forms in your scenario, the 125% target could be achieved even more solidly after the breakout. The most dangerous aspect of this formation is if the breakout fails. If the price reaches the top line and then pulls back toward the bottom, the pattern is invalidated and selling pressure may return. However, in your example, the fact that the price is very close to completing the cup and the target is high suggests that the probability of a breakout is stronger. Small cups, especially in low liquidity markets, can cause sharper moves. This is because buy orders after the breakout can push the price up quickly. If this move starts being discussed on social media or in communities, the FOMO, or fear of missing out, effect can kick in, further increasing the number of buyers. This chain reaction can even push the price beyond the target. In summary, the small cup formation is close to completion, and the expectation of an upward move equal to the cup's depth after the breakout is a very logical strategy in technical analysis. A 125% potential is a ratio that will attract the attention of both short and medium-term investors. If the breakout is supported by volume, follows the classic rules of the pattern, and is reinforced by psychological effects, the probability of this target being reached is quite high.
I wish you all a lot of profit. See you soon.